And Scott Bauer is joining us from Prosper Trading Academy. He's the CEO. Thanks again to Michael Keeley here on the TD Ameritrade Network, our contributor. Scott, let's talk about the potential for head fake. I mean, some of the analysts are saying for Lyft, don't be lured in by this, that cuts at Uber and still overall headwinds to this business model remain. What say you?
What say me for the trade for earnings is I'm not buying in, and I agree with some of these analysts. The rise up today, what is it, up 9% today, right in conjunction with Lyft?
Yeah.
If you look
Yep.
from a technical perspective here, there is massive resistance right up above here. That 200-day moving average, which has been massive resistance pretty much for the history that Uber has been a tradable entity, is right up above here, right around 32 and a half, 33 area. So I'm looking at that, and I'm going to take a very bearish stance going into earnings, even with this big pop today off the heels of Lyft. And again, though, Oliver, what I'm going to do, this is a trade. It's not an investment. Down the road, Uber, Lyft, they may be great once the economy gets going again. I'm not buying into it right now. So what I'm looking to do, and this is completely risk defined, but very bearish, I am selling this week's call spread, the 32-33 call spread, just up above where we're trading right now. At the same time,
Okay.
I'm also buying the 28-27 put spread. Okay. I can do that for a net cost of about zero. Okay. It doesn't cost me anything. I'm not collecting anything. If the stock explodes like Lyft did, my maximum risk to the upside is $1. I know exactly what it is. I'm willing to take that risk. However, if we get some disappointing news and the stock goes down with that market maker expected move, I can also make $1. I am very bearish here for the short term here. And like you said, I'm not buying into the move off of Lyft.
So, Scott, the structure of the trade, you're obviously still going to be defined in your risk because you're using spreads at both ends. You're not just selling a call. You're selling a call
Correct.
spread. Same thing
Yes.
when you're buying the downside exposure. When you do the downside exposure, though, why the spread there instead of just owning a put outright?
Also to mitigate some of my risk in terms of the amount of money that I would spend on the trade. Okay, so I'm looking at that market maker expected move, which is about $3 right now. And if I take that and look to where that puts the downside expectation on the move, again, this is a one-day move here, it puts me right at about 27. So I'm buying that 28 put, and I'm just offsetting some of the cost of that by selling the 27 put. Again, what happens next week, next month, totally different story. This is purely a trade for earnings. It's not an investment.
Okay. So buying the 28, 27, volatility here is obviously very high. So you are paying up for the options that you're going to own. But because you have both of these parts of the trade offset, your total cost is what, negligible?
Yeah, it's zero. So yes, that put spread is expensive, but I'm also selling a very expensive call spread, right? The volatility works both sides of the ledger there. So that's why I'm able to do this for zero. So my maximum risk, again, is $1. My maximum profit potential is $1 as well. I'm very bearish. And listen, if Uber does nothing here and it winds up between 28 and 32, it's a non-event. Doesn't cost me anything. I don't make anything. I'm just looking for a downside move here.
Gotcha. Okay. Scott, really interesting way to use options in a very volatile period coming into the earnings here in a volatile stock. Bet on some downside for Uber. Very interesting. I like it. Scott Bauer, CEO of Prosper Trading Academy. Appreciate the trade as always, Scott.